Because so many students attempted to complete a full analysis, I will carry on the rest of this suggested solution discussion using the analysis of equity. As I've mentioned before, the since to opening balance as well as the at acquisition section of the analysis was done by the client, so therefore you started with the given opening balances. But for the current year, equity attributable to P and NCI, you could use the analysis format, and therefore I'm going to follow that approach. So let's have a look at the analysis of equity current year movements for the ordinary shares. Here you always start with the profit of the subsidiary. Now in this question you had to calculate the profit of the subsidiary in part A to the question. So whatever you got that profit to be, you start with it here, and then please note, because it is a non-cumulative preference share and the dividend was declared in the current year, 1 year's dividend is attributable to the preference shares. So calculating profit attributable to the ordinary shares is the profit of S less 1 year's preference dividend. This then gets attributed to both the parent and NCI at their respective percentages. So this 415,226 you're going to see is now added to the retained earnings balance, and this 223,583 is added to the NCI balance. Together with that, an ordinary dividend was declared during the current year. Please note we're working with the dividend of the subsidiary in the analysis of equity. In this question, there was a total dividend given of 95,000. What you had to realize is to get to the ordinary dividend, you had to first deduct the preference dividend. That then gave you the 35,000 ordinary dividend declared by S. Again, this gets attributed to the parent NCI. The 22,750 is excluded from the profit of the parent. It gets eliminated against the profit of the parent, and the 12,250 is deducted from the NCI balance. Because the subsidiary also has preference equity participants, you also have to do a current year attribution and dividend declaration for the preference shareholders. So this is now an extract from the preference share analysis. What happens here is that 60,000 that you've moved out of the ordinary share analysis gets attributed to the preference shareholders at their respective percentages. So this 51,000 would be added to the retained earnings attributable to the owners of the parent. Together with that, there was a preference dividend declared in the current year. This would then again be attributed to both the parent and NCI. This 51,000 dividend income received by the parent will be eliminated against the profit of the parent as intra-group interest. What you have to pick up here is that this movement for NCI, the non-cumulative preference dividend of 9,000, being the portion at 15% attributable to NCI, was attributed to them. That's step one, but also declared in the current year. Therefore, it has no effect on the closing balance of NCI in the SFB. Please remember, we're busy calculating closing balances. So the amount attributed and the amount declared is the same. Therefore, the NCI closing balance should not change as a result. So looking at the non-controlling interest closing balance calculation, just to bring it all together, we have now calculated the correct opening balance. This amount comes from the analysis as already discussed. This amount also comes from the analysis as already discussed. And this was discussed with regards to the preference shares. If all of this is considered, the correct closing balance for NCI is 1,829,833. The final amount to calculate is now the retained earnings closing balance. Here we start with the corrected opening balance already calculated in calculation 5. These amounts have already been discussed coming from the analysis of equity. There's the 415 from the ordinary analysis. There's the 51 coming from the preference share analysis. It's the profit of S attributable to the owners of B. What now needs to happen is just adding the numbers of the parent, which is first of all the profit of the parent given in the question. From that, again, two amounts that we've already looked at in the analysis. There's the ordinary dividend income. There's the preference dividend income that needs to eliminate from the profit of the parent. Both these amounts we've already looked at on the analysis. Then the last step, thinking of what happens in a statement of changes in equity, is to just bring in the actual dividends declared that is allowed to be in the group. And that would be only the dividends of the parent. The ordinary dividend of 38,000 was given, and the preference dividend of the parent had to be calculated as 80,000. So once we've done that, we've corrected the opening balance, we brought in the profit of the parent, eliminated the intragroup interest income, we brought in the profit of the subsidiary attributable to the owners of the parent, and finally deducted the dividend declared that is allowed to be in the group, which is only that of the parent. This then gives me my closing retained earnings that should have been transferred to the statement of financial position of 5,389,876.